this is question 1 of paper 2. So right now I am going to go through the adjustments. So you have the following transactions of information that have not been accounted for. Okay, so first one, you have goods costing 6,500 were returned to credit suppliers. So the two accounts that are affected here is your inventory will go down, okay, because you are returning goods. And then your credit suppliers are what we know as trade payables, and because you are returning goods, so they will also go down, right? So go to your inventory over here, and you will just simply minus $6,500. Go to your trade payables, and because now you owe them less, you will minus $6,500. So this is the adjustment for the first one. So for the second one, here you have checks amounting to 6,700 were received from your credit customers. So your credit customers are paying you 6,700. However, they actually owe you $7,500. So in this case, what's happening is that you actually gave them a cash discount. Okay, so they owe you $7,500, but they don't have to pay you $7,500. They just have to pay you $6,700 because the remainder is actually a discount allowed. All right, so you have three accounts over here. So checks amounting to 6,700 is your cash at bank. So what's going to happen is you go to your cash at bank account. Okay. Your cash at bank account should increase because you're receiving money. But in this case, it's actually an overdraft. When you receive money, your overdraft gets lesser. So what I'm going to do is I'm going to minus 6,700. So the more money you receive, the less your overdraft will be. Okay? Your credit customers, on the other hand, they don't owe you so much money anymore because they paid you. Right? Even though they paid you 6,700, they should be decreased by $7,500. The remainder, which is known as your discount allowed, the remainder is actually $800 because you gave a discount allowed, so it increases by $800. It's an expense. Okay, so just to do your double entry, debit your cash at bank, 6,700, debit your discount allowed, 800, and credit your trade receivable, 7,500. For number 3, the owner took $20 cash for his personal transport, so definitely this is drawings. So go to your cash in hand and minus away $20 because your cash in hand goes down. Go to your drawings and you should plus $20 because the more the owner takes, the more drawings will increase. Question 4, cash sales of $55. This means that we made a sales revenue and received cash. So your cash sales, cash in hand will go up by $55. You receive $55 because you made a sales revenue of $55. So your sales revenue goes up. Okay. Number 5, business purchase furniture set for office use, $5,290 by check. So the minute you see by check, you know that your cash at bank is going to go down. All right. So if you look over here, it is still a bank overdraft. All right. So the more we spend, the more money we use out of our cash at bank account, the more our overdraft will increase. So I'm going to plus 5290, okay, because our overdraft is increasing. And then because we bought a new furniture set, I should go to fixtures and fittings. However, in this case, I don't have a fixtures and fittings account. So what I should do is create an account called fixtures and fittings 5290. All right, number 6, salaries of 1,230 and stationaries of 230 were paid for by check. So once again, you are using your cash at bank, your overdraft to pay for salaries. So our plus 1230 and our plus 230. Okay, the reason why I plus is because this is an overdraft. This is a liability. The more I use, the more my liability will go up, right? And my salaries, the more expense I incur for salaries, the more my salaries will go up. 1230. Now, stationery is also an expense, and it will go up because I bought more stationery, so it will go up by $230. The last one, 20% of the loan is payable on 31st December 2018. So what this means that we are now at 31st July, okay, in a few months' time, less than 1 year, we are going to pay off 20% of the loan. So the 20% is what we call a current liability. So I need to go and find my loan over here, right? And I need to take out 20% of it. So 20% times $16,000 is $3,200. So 20% is $3,200. And the rest of the 80% is my $12,800. So this 20% is under CL, current portion, and this rest of the 80% is what we call our non-current liability. So these are the adjustments for my income statement and balance sheet.